Hey everybody, this is Robert with Open Lane Funding. I hope you guys enjoyed the snow this weekend. I personally did not. I was hoping to get some motorcycle time, some two-wheel therapy, some wind in the hair. I have a helmet so I don't get the wind in the hair. Maybe the beard, but not the top of the head, not since I've been married. She's a keeper. Instead, I got to work on a project car. Don't recommend getting to working on cars as hobbies. A lot of stressful things go on with that. And I got to deal with chickens, tending to them. That was fun. Wife loves her chickens. If you guys don't know my wife, she's obsessed. Let's jump into it. This week's market update. I'm going to break down where mortgage rates likely are heading, which markets still make sense for investors, and what rising vacancies and foreclosures actually mean for you and your investment strategy right now. If you're an investor or an agent who needs to make real decisions in the next 90 days or sooner, this one's for you guys, right? Let's start with the rates. Let's see where those are going. As we talked about last week, rates are continued forecast to stay where they're put, right? That's assuming there's no major shock to the inflation and job rates. Nationally, some of the best growth opportunities right now are in smaller, value oriented markets, right? Research for 2026 puts places like Hartford, Rochester, Worcester, and Toledo near the top for combined price and sales growth, largely because they still offer space and affordability, right? People are looking more bang for their buck. What am I going to get out of what I have, right? Getting stuck, you know, I know it's been a little bit since, the pandemic, but being stuck in a small apartment, right? These people now finally have the opportunity, savings set aside to where they can go buy a home. They're going to want to make sure that their money is put to use. They're going to make sure they have extra space, right? Let's talk about what that growth projection looks like. Uh, in Hartford, it's 9 to 10%. Rochester, it's around 10%. Chester, it's around 10% as well. Toledo is around 13%. And this is all despite flat sales. It's because of what they're offering for what you can get, right? Bang for your buck. That's why these areas are jumping. Um, and it's crazy to think, 9, 10%, 13%. That's kind of what we're happy about. But as investors, growth is growth, right? You just have to adjust how you're buying these homes, how you're rehabbing these homes to make sure that you can still make your profit. Among the big metros like Indianapolis, Atlanta, Charlotte, Jacksonville, and Oklahoma City, they all stand out as more buyer friendly. So if you're looking to get the seller to wheel and deal, those are some markets to go do that. Uh, they're more affordable. There's less competition, so it gives you some upside potential, which is always great. What's always you're looking at as an investor, upside potential. If you're a mobile investor, right? So if you invest in areas that are not your just local market, it's worth comparing, right? What your dollar buys in these markets versus chasing the same cap rate in the high priced coastal cities or in your local market. I know in where I'm at, Spokane, Coeur d'Alene area, like especially the Coeur d'Alene side, pricing is high. So you got to go find the deals. You got to scrap for the deals. And we'll get into that a little bit later where you can find some really good deals right national vacancy rate is around 7% mark. That's up from mid sixes a year ago. Across the 50 largest metros, vacancy climbed to 7.6% in 2025. And most of those markets are now either renter friendly or balanced. Only a handful are still clearly landlord favored. Uh, some of those are going to be markets that you don't really want to invest in, like New York City. The city itself is putting all sorts of restrictions on these landlords, which you just want to stay away from. But then there's areas like San Jose, which is still landlord friendly. Uh, so you talk to me, and we can try to find you those markets uh, and see what we can find in those markets for you. For us as investors, right, that means two things. You can't assume that rent growth that you saw in 21 and 22. You're going to have to use conservative rent and lease up assumptions. You always want to be conservative in your numbers, especially in these markets right now. Product and location matter more. You want clean, well managed properties at middle market price points. Those will outperform right now the luxury units with optimistic pro formulas. All right. So don't be a slumlord. All right. Buy a home, fix it up, but don't go HGTV on it. Those people don't make good profit, especially as landlords. You're not going to get the money. You're not going to get that return on your investment. You want to look for your ROIs. That's where you want to live in your ROIs. Regarding foreclosures, they're up 14% from last February, which could sound scary, but they're down 87% from the last housing crisis peak. So that's fantastic. We're not in a dire area, right, where we're going to hit 2008 again. No, we're still safe, right? Yes, they're going up a little bit, but as investors, that's, it's a market reset, which is fine. It's not going to drastically change anything. It's not going to, you know, hurt your current deals. You just have to be targeted, right? Find the good deals. Be conservative with your numbers. What that means is that means, selective distress and some targeted opportunities, especially among the over leveraged or FHA borrowers. That's not going to flood the market with listings, but if you want to be that investor, who is ready to get rocking and rolling, go hit up some pre-REOs, right? Find those homes that have been hit. So okay, now you can go negotiate with the seller. Hey, I'll give you 20 grand, but that's about it, right? These people are about to lose everything. Help them, save them out of their situation. Sometimes you can even negotiate, with the lender to get a short sale. Say, hey, they're upside down. Give me this for market value and I'll buy the home. They're probably going to have to do that at auction anyway, so why not save them auction fees? You're helping everybody at that point. But just don't turn a deal down. You have to just roll your sleeves up and get dirtier and get more creative on where you find them, right? Uh, you know, Investors, that also means that you guys got to be ready for financing, with financing readily available for you when these distressed pockets start showing up, right? Reach out to me so we can talk about opportunities that I have for you and talk about gaining down a strategy, putting it on paper, so to speak, right? That's the best thing to do that holds yourself accountable. Put your strategy on a paper, put it on a wall, and get it going. Then you can hold yourself accountable. There's nobody in this world that can hold yourself more accountable than yourself. At least that's for me, right? Big picture, the Fed is stuck between a still elevated inflation and a cooling job market. Their preferred inflation gauge is around 2.9%. That's still above their 2% target. Oil prices plus geopolitical risk are keeping pressure on those numbers. Job growth has clearly slowed, right? That's kind of what we were talking about at the top of the page, where these are directly inflating or affecting where these interest rates are at. There's slowly monthly payroll numbers, and unemployment is still in the mid fours. So we're not in a deep recession scenario. So that's great for the economy overall, but there's still some risk, right? All of this is why the Fed is pausing. They're not cutting aggressively, and that's why rates are drifting gradually rather than collapsing. And that's why they're projecting, for the whole length of 2026, that the rates will stay stagnant. They're not going to go up or down, right? You're most likely not going to see rates below 6% this year. So if you're looking to buy a home, let me know. I can also help you with that. I can help with owner occupied stuff as well. Just let me know. Um, as an investor, you want to watch for three things every single month: inflation points, job reports, and the Fed meeting commentary. These are going to help you get a better understanding. And if you don't want to do that, just wait. I'll show you. In these weekly meetings, I'll go over those 3 points and I'll tell you, hey, this is where we're projecting. I'll summarize it, right? That's my job. Make your life easier. Put everything in one spot. That's why I'm here. Uh, those three will drive your future refinance and acquisition timing as well, right? Let's wrap it up a little bit. So plan on mid sixes for 30-year fixed. You can get down to the lows, sometimes under six for very well qualified borrowers. For DSCRs, you're going to average about 6.5, low sevens in that ballpark range, with the opportunity for well qualified borrowers to get lower than that as well. I think the rates I have right now for DSCRs are right about base at 6.125. And some of these lenders also offer buy down. So let's talk about customizing this for you and how we can do all of this. Maybe we can make the seller cover your buy down points, right? Let's look to the value markets for better cash on cash. Tighten your buy box. It's crucial in this market right now to tighten your buy box so you can make sure that everything that you're doing is affordable. Underwrite your numbers conservatively, right? Don't underestimate your rehab budgets. Don't overestimate your ARVs, right? Make sure that you're going in there with conservative numbers so that you close on a deal that's going to turn you a profit. If you want help structuring your DSCRs or other investor focused, financing, fix and flips, whatever you need, right? Or you just want a second set of eyes on your deal or analyzing, reach out. I'm happy to walk through your numbers and show you funding markets in this area. See what I can do for you. If you found this helpful, please forward to your friends, follow my page, send me a call, text message at 208-215-9936 so that I can be here to show you and to help you in this market. Thank you, everyone. Have a fantastic week, and I look forward to talking to you next.